Hello, how are you?
Good. How are you?
Good.
Let's
Yeah,
introduce you first to the audience, and
yeah,
I want
sure.
you to do it yourself.
Yeah.
And including, I want you to add the part where you were a professor. So start from the beginning. Take your time with it.
Yeah. So, uh, uh, so I have had. Let me start with this. I'm not a traditional fund manager that everyone would expect. Like I don't sit and read balance sheets and financial statements and come. It's not nothing related to bottoms up, and it's related more maybe my decisions are based on macros. So the thing going back, I started investing. Like what got me interested in markets is in back in 2007 8. The markets were going up like crazy, and I used to
Hmm.
feel like I am being left out, etc. I didn't even know how to invest in stocks at that time. And one of my friend who was a chartered accountant, he educated me regarding how to look out for companies, etc. But it was an overview. Uh,
So, what were you doing at that time in 2007 8?
2007, I was studying MSc virology. So at that time, nobody knew what virology is. Today, like people used to ask me if you study computer viruses, but I used to study human viruses, and thanks to the COVID-19 pandemic, nobody now asks me what virology is about.
Of course, yeah.
So,
You're a
yeah,
hotshot now.
maybe.
So you were studying virology. That
Yes,
was your master's,
yes, and
and
I
that
did.
time you got interested in markets,
Yes, yes,
and your CFA and then taught you how to look at markets.
yeah.
Okay.
So CFA was still 8 years away from 2008 when I
Hmm.
started pursuing CFA. So after I started investing, my first entry in the markets was in January 2008, and I have uh, like maybe I can say I was fortunate enough to experience that fall at the
Hmm.
time when I entered the markets, because the corpus that I invested was small. So I started small, failed fast, and learned from it, fortunately. And touch wood, I have survived after that. So
Exactly. Very few
yeah,
people would have survived who started at that time.
yeah. And people underrate survival in the bull markets, and they overrate performance in the bull market. So in the situation we are today, people will always look at past returns more. They will put more weight on past returns, but survival
Hmm.
is very important in the markets. That's what I have learned. So after my the post graduation, I started. I dabbled with couple of businesses. It was in like I undertook a project of fusing two bacteria which might have some commercial potential. It failed. Then I started a school with my sister and later sold it out. We started a business of paper-based air fresheners, sold it,
Hmm.
and
I
then
remember that one. Yeah.
yeah, I consulted you about regarding that. Yeah. So after that, I joined Modern College as assistant professor. There, I used to teach virology, biotechnology, etc.
Very cool.
And then it was interesting. Like the CA friend who taught me how to invest, he was still saying me that you try and pursue CFA, and I was like, okay, I'll think about it. It's too costly, etc. And in that time, one of my friend, she went to Harvard, and she was back for her midterm break. And I asked her like how much is the tuition and what are the total expenses. So it was coming closer to rupees 1 crore at that time. And then I
Hmm.
calculated what would be my expense if I uh, take CFA level one and join class, and it was closer to 1 lakh rupees. And so I thought, like, yeah, I am wasting too much time in taking this decision, which is going to help me how to invest money. So I better invest something in this. So
Time and love.
at that time, I joined FinTree. It was September 2015, and you advised me that since I'm not from the commerce background, I'll take the June exam. And but still, I in the September to December part where I was allowed to attend the classes of the previous batch, I was very much sure that I want to pursue this further. And so in April itself, I left my job as assistant professor, and after clearing level one, I joined in my current company, Wealth Manager. So, and here also I was very fortunate. I My role has been advancing uh, in congruence with the CFA curriculum. So, in the first year, I was here as financial planner, and later on, I moved on as a research associate, and then into fund management. So, and before that, I was in advisory division for quite some time, and I was dealing with some family offices from our in our clients, and so there I got to learn a lot of concepts of portfolio management that are taught in level three firsthand, and it was very good experience. I could experience everything practically. So there are a lot of differences learning it in theory and in practice. So
Of course.
that was so this is my journey. So I'm not an traditional like this is according to me it's unorthodox way of becoming a fund manager, and I still don't do any fundamental deep micro analysis of companies and financial statements. But I've learned is that decision making is far more important, uh, or maybe equally important as analysis. So today, analysis is available. There are plenty of good analysts who have their own YouTube channels, and they are pretty good at it. Like their research is very in depth. So but decision making is totally a different ball game. It's
Mhm.
different managing say let us say if I have 10, 15, 20 lakhs 30 lakhs of my own and I want to invest that, that is a different thing. And when I get a portfolio of 100 crores, it's totally different ball game. The conviction totally changes. Like if I'm taking 15% position in my portfolio, I will think couple of times more than what I
Of
otherwise
course.
would when I'm investing 15 crore in a company or something like that. So it is more about decision making. So I also read more books about decision making than about analyzing companies per se. I read a lot of stuff about how macros are placed everywhere in the world, not just in India. But um, with respect to company analysis, I trust a couple of people, and they are pretty good at it. So that's
So to summarize, Shartul, you're a science professor turned
yeah,
a CFA charter holder,
yeah,
who's now a fund manager,
yes.
and you've done the whole transition of being a science professor to a fund manager in about how many years? 10 years?
Uh,
No,
yeah,
less than that. 7 years.
yeah, 7 years. You can say.
That's
So,
fantastic. And I didn't know you were a fund manager because last time we
oh,
spoke, which was quite some time back, I think
yeah, yeah,
you were a research associate there.
yeah. So that time we were working on these funds that we have right now, and there was SEBI regulation that I should have 5 years of experience before I become a fund manager. So
Hmm.
last year, my in October, my 5 years of experience completed, and then I became fund manager.
Congratulations.
Yeah, thank
Wow.
you.
And what fund is this a PMS structure or how
Yeah,
is this
yeah.
fund working?
Yeah,
It's a
this is
PMS.
so. Yeah, it's PMS. So one of the PMS is a PMS of mutual funds. Only a couple of guys in the market are doing it, and other two are quant strategies. And
Okay. So how many funds? Total three funds?
yeah, three funds.
This is now interesting. I asked this question to one other YouTuber recently, Parimal
Hmm.
Ade, if you know Investment
Uh,
Yatnya.
yeah,
Okay,
yeah, yeah,
he runs a popular
yeah.
channel and he's also a
Huh,
distributor or an
yeah.
advisor. I'm not sure, but I asked him this question: why would someone want to buy multiple mutual funds in a portfolio?
Hmm.
I mean, from a finance perspective, does it really make sense? Because on an average, one mutual fund will have 30, 40 stocks,
Yeah, right.
right? So if I'm building a portfolio of 5 funds, I'm
Hmm.
actually I'll end up having exposure to at least 150 odd stocks.
Yes, right.
How does someone make money in that environment? I mean, what's the rationale there?
Majority of the money is made through asset allocation. So that's either across asset classes or within asset class. So if you look at even within equities, there are certain periods when small and mid caps perform far better than the rest of the market, and uh, most of the times that is the period when most of the mutual funds outperform the benchmark. Rest of the period, like if you remember in 2018, everybody was talking about like passive is the new thing, like mutual
Hmm.
funds, like the fund managers have lost everything. They cannot add alpha to the portfolio. But if you look
Correct.
today, the alpha addition for last couple of years is significant. That is majorly because of the small and mid caps. So interestingly, SEBI came up with lots of regulations for mutual funds, and now large cap schemes cannot invest more than 80% of their corpus in less than 80% in large cap companies. So there, the outperformance to
Sorry, I
index,
missed that part. Less than what you said? Less than?
they have to invest at least 80% of their
Correct.
corpus
So
in
if
large
it's
cap
a
companies.
large cap fund,
Yeah, yeah.
right?
So now large cap fund managers will find it difficult to outperform the index Nifty 50. When I'm talking about an index, it's mostly Nifty 50. But still within that, if you have a look at a couple of funds which have value bias, they are performing better than the rest for now. And these funds, if you looked at them in 2018, you would have thought like these are old fund managers. They don't know the current game, and basically we should now write them off and not even include them in our research going. So there is so I wrote something called cyclicality of alpha for our investors, and there I pointed out that you take any scheme and it's alpha, let's say 3-year alpha over Nifty, it is cyclical. There are periods when the scheme is generating alpha, and then there are periods when it is not, and that basically can guide your asset allocation. So you are right. If you just choose 5 mutual fund schemes, you may end up with over diversification, and that may not add value to your portfolio at all. But if you have chosen 5 investment schemes and in such a way that they have low correlation with each other, then probably you will end up with very low volatility in your portfolio, and then you can outperform the markets with that asset allocation approach across different schemes. And so it is what you can say, like how you look at it can be different, because I have seen concentrated portfolios that have given superior, far superior returns, and uh, but it is not everyone's cup of tea.
No, I get that. So again, just so that I understand well, and I'm just curious, like
Mm.
in terms of how it works. So what you said is that so how many like mutual funds if you are at the liberty of sharing, how many funds you have in your current scheme?
Currently, we have eight.
8 mutual funds,
Eight.
and all equity or equity plus debt mix.
No, we don't have debt.
Okay.
But our portfolio is structured in core and satellite model. And
Right.
in the satellite part, we take exposure to sector schemes, thematic schemes, which otherwise we used to avoid taking exposure to, because these schemes are very volatile, and the exit is very important for such schemes. So
Hmm.
they can add alpha, but only for a particular period. So you can call it as a trading portfolio. I have entered and exited in schemes in a span of 6 months or so. That is
So it's
not
like trading on a mutual fund,
yes, yes.
where
So
we will
basically, I will
probably
say
also have
I'm
exit loads as well.
yeah, yeah. So I'm looking at returns which will take care of everything. So I don't want to be limited by exit loads. So I have sold a couple of mutual fund schemes with 25-30% return in a span of 6 months, and
Hmm.
I did not worry about exit loads. And I think the
Yeah.
asset management companies have also realized that this is how they should place this product. So most of the sectoral schemes now don't have any exit load, or they have exit load only for a month or 3 months
Hmm.
period. So
Hmm. Okay, so eight. So let's say I'm writing you a check today,
mm,
50 lakhs or 1 crore. The
mm,
money gets deployed into 8 separate mutual funds. On an
yes,
average, per mutual fund, they will be holding of about 30 stocks,
yes,
but some
yeah,
duplication here and there.
yes,
So we're
yes,
looking at about a portfolio of 200 stocks. If I look at it,
200, 250,
200
yes,
stocks.
Yeah.
You're saying that what you try to do with those 8 portfolios is you would figure out if the current market is appropriate for small caps, mid caps, large cap,
Right.
value versus growth, and then that's
Yeah.
how you place your bets, right?
Yeah.
So, which means, are you saying that it's some sort of a factor driven? So you're betting on the factors rather than the
Uh,
themes. Is that where it's going?
we are betting on themes right now, but we are definitely looking at factors. So right now, it is not part of the overall research methodology per se, but we are definitely looking at factors. And if we can have a portfolio of just factor funds, so now there are quite a lot of factor funds. Like 2 years ago, there were many funds that will allow me to take exposure to quality or momentum, but now the options are being made available by AMC.
Hmm.
The thing is that most of them are coming in ETF formats rather than index fund. So I would like index fund better than ETF.
So let's say that there are. So you would say that probably you would buy a value mutual fund, value oriented scheme, maybe, or a
Maybe.
growth oriented scheme, right?
Yes.
So that is also a factor.
Yes.
So for this scheme to work, the underlying assumption is that within mutual fund the correlation is very high, but
Yes.
across the scheme the correlation is low,
Low. Yes.
right? But if you have you done some back testing, like do you think that's true?
Yeah. See, we track mutual funds like returns of about 450 schemes every week, and
Okay.
the tracking is based on last 1 week to 10-year performance. So even within large cap schemes, at times you will find the worst performing scheme has given you say a return of minus 10%, and more best performing scheme would have given you a return of 10%. So
Hmm.
at even within diversified mutual fund scheme, there is you very wide range of performance, say let us on 1 year basis or something like that. So there is something going on there. So you cannot say that all the large cap schemes are performing equally good or equally bad. And there is always a period wherein you can find such difference between within the category of particular funds. And likewise, you will also find a category of funds. Like today, if you find look at small cap category as such, it has performed very well for last 2 3 years.
Hmm.
So this divergence of performance is always there within different categories of mutual funds and for mutual fund schemes within a category. So we try to exploit that, and we try to position ourselves so that we land in first or second quartile of this performance range.
Some sort of a momentum based strategy, because you're looking at past 1 week's performance and then you're
Uh,
saying,
no, no, no. We don't place our bets based on past week, 1 week, or so. Like we may look at performance as validation of our hypothesis in this portfolio, but
hmm.
that is not the generator of ideas. Like so,
So you have the idea first, then you go
yeah.
and test, and momentum is some sort of a
Yeah, so maybe
evidence.
if it is say commodity oriented mutual fund, I'll take a smaller bet, maybe 5% of the portfolio, and if that is validated by price performance, I will increase my bet more to like say 7.5%, 8%, 10%, like of that. So overall, my tactical part is limited to 35%, and
Okay.
within that I cannot allocate more than 10% to a particular scheme. So if I put some constraints like that, it automatically limits my risks,
Hmm.
and at the same time allows me to take that exposure.
Tell us a little bit about this quant funds now.
Yeah,
What's with the quant fund? I hear a lot of quant funds. Everyone is doing a quant fund these days.
yeah, yeah.
Uh, what's
So
happening there?
yeah, so thing is that I think most of people have got inspiration from Jim Simons, who manage a fund called Renaissance Technologies. And uh, his fee structure is 5% fixed fee and 44% performance fee. The post fee
What?
returns, yeah, yeah. This is the most exorbitant fee structure I have ever
For a
heard.
quant fund,
Yes,
which
yes,
is machine driven.
Yeah, and the post fee returns are 36% CAGR since inception. Yeah,
It's a money making machine. What's the
yeah,
algorithm? We want that.
yeah. But it is, as you said, limited by liquidity. So that fund stopped accepting money long back, and most of the money is of the employees and the founders of the company, and basically it's Jim Simon's money. And so they have particular variables wherein they have data dating back 1,000 years, and so
Wow.
based on this data, so Jim Simons is actually uh, he was hired by the American government to crack codes during the Cold War era. So he
Okay.
realized that whatever I'm doing, so whatever mathematics he was doing in that, I can apply it to stock market. So Jim Simons was working as code cracker for American government during Cold War, and simultaneously he was managing his portfolio with the quant uh, uh, methodologies. And later on, he realized that I can make a lot of money with this. He hired, so or he hires physicists or maybe mathematicians or some other, like he doesn't hire maybe CPAs or something like that in America. So, and all his investing is driven by uh, not looking at financials, just looking at these quantitative variables. So most people have like I am inspired by his approach. So I definitely wanted to explore how these factors work, etc. And so right now we have a momentum based strategy, which is I will say it is easy to uh, uh, design and execute. Uh, all
It
these
will do
strategies,
well in this market.
yeah, it is doing
Momentum
well in this
strategies will
market.
do well in the
Yes, yeah.
MLS.
But I think, as you said about real estate, probably going forward, they will struggle a bit. So, as you talked about real estate in US, the housing prices are collapsing. So, if you look at it, one of the reasons for that is the 30-year mortgage rate has gone up from
Hmm.
3% to 6%. So
Yeah.
that is what like I forgot to mention this. So in India, as you said, the EMIs are going up, but they are not going up by that margin.
Hmm.
So
At least not yet.
not yet, yeah,
Not yet.
of course not yet, yeah. It is very difficult to predict how the interest rate cycle will pan out, but that will
Hmm.
have uh, a lot of bearing on the how real estate market is going to
But
perform,
if you look at 10
especially the,
year, sorry, I'm cutting you
yeah,
again. But if you look
yeah,
at 10-year yields now, they've already
mm,
priced in, significant
yeah,
rates hike,
exactly,
right? So,
yeah,
so
yeah,
maybe we are going that way.
yeah,
Maybe.
exactly. So
But yeah, interesting.
likewise,
Coming back to quant, yeah, coming back to quant fund.
likewise, momentum strategies in US have already underperformed for quite a lot of time to the US markets now, and there are like in India it is still a small chunk of overall market, but in US it is the corpus with these ETFs is huge, and they underperform these like once the corpus becomes huge and your strategy is out in public, how you are going to manage it, it becomes food
It
for
can
hedge
be
fund
rigged.
managers. Yeah,
Yeah.
so they make money on at your cost.
Hmm.
And in such strategies, the trading and rebalancing criteria and how you trade actually matters a lot, along with how you design the strategy. So that is where theory and practice can diverge a lot.
Hmm. So is
So
it some sort of a HFT? There's also an
no, no,
HFT
not
component to it?
HFT.
No.
No, no, no. We look at
Okay.
our portfolio monthly. We review it
No,
every
not
month.
yours. I'm talking
No,
about the Jim
no,
Simmons.
no, no, not
That's
in
not an
US also.
HFT.
Yeah, most
Okay.
of the like if you look at momentum index, Nifty 200 momentum 30 index, it's rebalanced every 6 months.
Okay.
So that's what I'm saying. Like 6 month rebalancing, according to me, is too lazy for a momentum driven fund. It
Of
can
course.
be a
Of course. Yeah.
appropriate period for a value fund or maybe a quality fund, because if you look at underlying parameters how a value fund is designed or quality fund, they are basically looking at data that is published uh, like the highest frequency is a quarter.
Quarterly.
Yeah, and only the so to every variable, price is going to have an effect. but that is only part of the equation. That is not the whole of the equation. So whole of the equation changes every quarter. So you shouldn't be rebalancing these strategies more frequently than that. But for strategies which are driven by price momentum, the whole of the equation changes daily. But daily is not like then you will spend a lot in trading costs. So I think month is a right period to look at review these portfolios at least. So that is one factor. But what I'm interesting what I am more interested in is the concept of factor momentum. So if you look at
Okay.
momentum, momentum should actually capture different themes at various periods, because
Hmm.
basically you are buying something which is going up in price.
Hmm.
So if today you say that value stocks are going to perform better, so my
Hmm.
strategy should capture that, and at point my portfolio should be dominated by so-called value companies. At point my portfolio should be dominated by so-called quality companies. So probably back in 2020, the fall of March 2020, the portfolios will be dominated by quality names.
Hmm.
Later on, at some point when the mid cap and small caps were going up like crazy, it will be dominated by least quality names, because in such bull markets, these stocks perform far
But
better
then,
than the quality names. Yeah.
if you're following a momentum strategy, wouldn't you
Mhm.
double down on small caps because they were going up by the inherent nature of the strategy? Because what you're saying is a slightly more contrarian approach, right? Upar chala gaya, so I'll move somewhere else.
No, no, no. I am saying that there will be more small caps when
Right.
after when the rally started after the fall of 2020. There are going to be more small caps in
Hmm.
the portfolio, but eventually, like before that, it would have been dominated by quality names. Later on, by small caps or lower quality names. At some
Hmm.
points, maybe it would have been dominated by commodity names. At some point, mid cap IT, which was doing phenomenally well.
Hmm.
So each and every sector or theme that is doing well in market should perform of a momentum portfolio at particular time. And
Hmm.
this is what I mean. I'm saying, like when I'm pointing to factor momentum. Momentum is not basically with the company. So if you look at various momentum portfolios, they will maybe have exposure to two or three sectors. Majority of the
Hmm.
exposure will be two or three sectors or two or three things. So that is basically the factor which has got the momentum. So um, at times low PE stocks will perform, at times high PE stocks will perform. So this is the factor. So low PE, when traditionally it is called as value, but it is coming in my momentum portfolio. So I'm more interested in that concept of factor momentum, because I can build a portfolio of mutual fund on there again, rather than playing stock specific. Yeah.
If you can
And
find the funds that play that factor.
yeah, definitely. And secondly, when you said about momentum will double down on companies which are doing well, so that is definitely true. But most of these strategies, including ours, is limited by caps on the maximum
Hmm.
weight for companies or sector. So some or the other constraint is always there on every portfolio that is being managed. That's part of risk management. Mm.
Hmm. See, the problem with momentum is, I think, by the very nature of the strategy, it needs to be a short term. That's what
Yeah,
I think,
yeah,
right? It needs to be a
exactly.
short term game, like maybe a weekly rebalancing, or even because, for
Yeah,
example,
weekly
if
is
let's
too
say,
frequent,
just for the
according to
sake of
me.
argument,
Yeah.
let's say if I identify small cap, quality as a particular uh, factor to bet on, and
Yeah.
then I double down on that factor.
Mm.
Within a month's time, the stock could take 30-40% drawdown. So by the time I rebalance, I've already,
Yeah.
booked a lot of losses on it.
Right. Yeah. Yeah. So that is part and parcel of the portfolio. So it
Hmm,
is by
interesting.
nature a high volatile portfolio. So as I said, like this is a very high volatile strategy, and I'm better off because I don't have to uh, take each and every decision. Most of the decisions are driven by the model, uh,
Right.
because it
So
is
the
very
model is
difficult.
already developed.
Yeah,
Model for you is already.
yeah.
And how long have you been testing this model now? How old is this fund? This
Uh,
scheme?
How? Yeah, this
This
is
scheme
1 year old scheme
and
now.
back testing prior to that
Back
for how many
testing
years?
was 15 years, for 15 years.
Wow. And what was the CAGR and the back testing period?
Back testing CAGR was 26% CAGR.
Wow, that's
Yeah.
fantastic.
Yeah.
And last 1 year?
Last 1 year was 42.5%. Yeah.
Wow, that's great.
Yeah. But yeah, as I said, like, uh, we are still looking at like when to stop. Important part of such strategies, as I said, is the AUM. So at some point we will have to stop taking more money because we ourselves will drag down our performance. So
Hmm.
take an example. So let us
Impact
say,
cost.
suppose,
You're talking about no. So
yeah, impact cost.
you anyways doing mutual fund, right?
No, no, this is
Is
PMS. This is stock
so
specific. Uh,
Quant PMS is stock specific, not
Stock specific. Yeah, we have
okay.
20 stocks.
Right. Yeah. So your impact cost will go up quite
Will be high.
significantly, is
Yeah,
what you're
yeah,
saying.
yeah. So such
Very good.
strategies may not be scalable to a large extent. So if you look at it, say 1,000 crore rupee portfolio, total AUM, and you are taking even say 2% position, you are 20 crores on in
Hmm.
a single stock. So and by nature, the trading happens on if a strategy is trading on a single day. So the company that is going out, so 20 crore you sell on one day, and you buy 20 crore in other company
Hmm.
on another day. So you will have say 20 crore in a single position, and entering and exiting that volume may also be tough in
Hmm.
maybe markets that are thinly traded
Hmm.
back in 2020. So just
So you're basically saying no to new investors here, is it?
not right now,
Okay.
but we have to monitor that part actively. Like, should we be
Hmm.
accepting more money now or not?
Hmm.
Because such strategies can uh, like they can start underperforming if corpus reaches beyond certain amount.
Hmm.
So right
Interesting.
now we are not at that stage, but we have to
Might reach
monitor
there.
that. Yeah. So
Especially with momentum, you might reach there in a month without
yeah,
taking new money, right?
yeah, yeah, maybe.
Okay.
That would be great if you reach there in a month. So
Great.
yeah,
Fantastic.
but that
It's
is the basic difference between back-tested portfolio and the live portfolio. And
hmm.
in the backtesting, you cannot account for the impact cost truly. You can build it into your model, but it is difficult to account for it because see, the impact cost that NAC publishes on their website, it is for a volume of 1 lakh rupee trade, and
Hmm.
impact cost for HDFC Bank is say 0.03%. So basically, you will end up
Does it even have impact cost for 1 lakh? HDFC
yeah,
Bank?
yeah, it's yeah 0.03%. So
Okay.
basically they take mid market quote and how much extra you will be paying for a buy transaction, and how much less you will get for a sell transaction than that market quote if your volume is 1 lakh. So
Right.
I feel I haven't tested this, and I do plan to do this, but we don't get entire bid ask the order book,
You just
but
get five.
yeah, five. And I think Zerodha gives 20 or 10 for some of the companies.
Okay.
Yeah, I don't know how they manage to, like, I haven't tried to get into that, but they do get this. But still, see, I think that cost will go up exponentially when the volume increases. So from 1 lakh
100%.
rupee to, yeah. So,
100%. Yes.
yeah. So
It's
that,
not linear. That's what
yeah,
you're
yeah,
saying, right?
yeah,
Yeah.
yeah, yeah.
It's
So that
definitely
is
not
very
linear.
difficult to factor in back testing, and that is why
Hmm.
you have to be cautious with scaling up strategies that are back tested.
So let's talk a little bit about careers now.
Yeah,
Okay,
sure.
so the whole theme of this show is basically to inspire CFA, FRM, or finance students in general,
Yeah.
and you're a role model. Being a science professor
uh,
with no background in finance whatsoever, no relatives,
yeah.
and you've
No.
kind of created all the opportunities by yourself, right? Right from the
uh,
job that you have,
yeah,
and becoming a fund manager within a short span of 7 8 years is super
yeah.
impressive. So you've
Thank
done
you.
you've done pretty good.
Yeah, yeah.
uh, so give us, for CFA candidates, I want you to give. So first, I want to know whether CFA is really worth it in your eyes. Like, has it really helped? And then second, I want you to give some tips to the CFA candidates in terms of
Hmm.
how they should approach things.
Yeah. See, CFA. First of all, it is definitely a very in-depth course, and I haven't found. I have had looked at MBA curricula, and they are not in-depth for in terms of financial concepts. Probably CA curriculum is more in-depth as far as FRA part is concerned. But the manner in which CFA curriculum covers different aspects of financial world, may it be the corporate finance part or fund management part and behavioral parts,
Hmm.
is like there is breadth, but at the same time there is depth as well. So
Hmm.
that is a huge advantage of CFA curriculum. One disadvantage that I have found, that hasn't been like it hasn't been a disadvantage for me, but many big companies will still look for MBAs
Hmm.
for certain positions that CFA candidates aspire to be in, and that is basically by nature of these companies. Like, it's not like a person sitting there and he is judging that, oh, this person is MBA and this is CFA, let us hire that MBA. It's their way they structure their advertisements. And most I have heard that most of the advertisements will look for that MBA in your application, and if that is not there, that will be automatically rejected. It will not
Hmm.
even land at table of
But
the
why do you
interview.
think that's the case? I mean, for some roles, I get it, right? Like, for
Yeah.
example, you need front office investment banking. It's a people facing role, a little bit of
Yeah.
sales skill involved. But
Yeah.
a middle office role or a equity research or fund manager, from a learning perspective, I think CFA is 10 on 10. I mean, what else can you
Yeah.
learn?
Yeah,
Why do you think
definitely.
that's the
Equity
case?
research analysts, CFAs do get a chance to get into that role, and but still, then they most of the uh, what you can say, most of the recruiters will look for CA or
Hmm.
maybe some background in financial statement analysis,
Correct.
because and I think that is actually required when you are, if you want to hire someone to read through all the lines of financial statements, probably CA or CS would be better.
Hmm.
uh, I would I will be more inclined to hire CFAs in client facing roles rather than
Okay.
all the research roles, because, and especially for a firm like ours where we deal with HNIs, we cannot afford that somebody doesn't know something in front
Hmm.
of a client. And
Right.
so and so that is why, that is my inclination. We do have CFAs in our company, and whenever there are research positions, we also look for CFAs. And today I am in a position that I think we should also look at FRM candidates, or basically someone who can deal with a lot of quantitative data.
Hmm.
And it the person may be a statistician or something like that, because that, I according to me, is becoming a pressing need, that you need to be having someone who can
Contributing.
analyze a lot of data.
If you're
And
hiring, I can send you CVs.
not right now, but I will definitely, as I will, I'll definitely let you know if we are
Sure.
hiring someone. Yeah. So so that is one thing, that CFAs, according to me, being analyst, being research analyst, and then climbing up to the ladder to a role of fund manager, is a dream. I also had that dream. But as I said, that I am a pretty unorthodox fund manager, and the way I have come here is also unorthodox. And uh, I think everyone should be open to new roles, and um, at times it is important to be there rather than waiting for the perfect job or perfect role of that analyst role. Uh, there is also one thing, that once you get the sales guy stamp, it is difficult to get into research.
Hmm.
I agree to that. But if you get some role that is similar but not exactly the same what you want, I think you should get in, because being there matters a lot. You are privy to a lot of information when you are inside than when you are outside. Many positions will open up, and they may be getting filled in from the within the organization that you are not privy to, and that is how
Correct.
you won't get any exposure to that opportunity. So it's better to be in there. I have seen many people who have transitioned from sales to research, or maybe from operations to research. So couple of months they do some kind of operations, but then they move on to research. Of course, you have to have employer who has that open mindset.
Hmm.
So
It's generally easier with smaller employers.
yeah, yeah,
For larger
definitely.
employers, I've
Yes.
seen it's
Yeah, it's very difficult.
almost impossible to move from operations to maybe
Sales, research. Yeah.
research role. Yeah.
Yeah, but the problem is that uh, the number of research people required is very
Is
limited.
also less.
Yeah,
Correct.
so it's not that, like, see, if my portfolio size today is 1,000 crore rupees, I'm not going to require 10 times more people if it grows to 10,000 crore rupees.
Hmm.
So that
Correct.
limits the number of opportunities. But for growing from 1,000 crores to 10,000 crores, I may require a lot of salespeople. So that is by nature of this business, that you even you
Interesting.
would be
Yeah.
getting a lot of sales opportunities than opportunities in research and FinTree placements. So
Hmm. Correct. That's true.
yeah.
That's true.
So according to me, like, uh, if you get into a role which is similar to what you aspire to be, it's better to get into that. CFA has an advantage of being, as I said, it has breadth as well as it has depth. But at the same time, now I feel that you should also have understanding of quantitative finance. Even I'm
Hmm.
trying with the Pune chapter of IIP that we should now conduct various workshops on quantitative analysis, because quant analysis, at, at least when I was pursuing CFA, that was not major part of the curriculum.
Hmm.
And secondly, there was no practical aspect to it.
Yes,
But
that's still true today.
yeah, yeah. So a fixed income fund manager will require different quantitative analysis. Equity fund manager will require different, and asset allocator will require different quantitative analysis. So because of this, I think quantitative analysis should be one skill set that everyone should try to acquire, especially if you want to get into research,
We,
because
we
that
are
is one.
introducing a program, by the way,
Okay.
on
Oh,
Python for financial modeling,
oh,
which
okay.
basically will incorporate everything that you just spoke about. I think towards the
Yeah.
end of the year we should be able to do it.
Oh, that would be interesting.
Yeah.
Yeah. So that is because, uh, probably that skill set is something which will open many doors if one is aspiring to be in research department
Hmm.
of the firms, because
Correct.
there are not many quant analysts right now.
So your advice to CFA candidates is twofold. A, you said learn accounting because you said CAs are better at some jobs,
Yeah.
but
Yeah.
CFAs can learn accounting pretty much as much, right? At least they have a
Yeah.
basic foundation there.
Sure. Yeah.
And second, you're saying learn quantitative skills,
Skills. Yeah.
right? Data analysis skills, maybe
Yeah.
coding or maybe
Yeah.
just being better with data per se.
Yeah. Even I still know that there are lot of features in Excel that I'm not aware of, but they
Yes,
can do the job very well.
correct.
So I
That's true.
am learning those, or trying to learn those as well. But that is what I think is going to help a lot with research, even to me. So
Fantastic, Shanto. Thank you
yeah,
very
thank you
much
very much. Yeah,
for
it was
taking out
good to
precious
connect
time.
with you.